Thank you very much. And I'm not even sure that I'm in the right show, because most people who come in the door here are very focused on funds and share investments and trading, and that's absolutely not where I'm at. But I think that what I'm going to talk about has a very important place in your life, and it'll be interesting to see when I get to the end whether you agree with me. So we're going to cover a big agenda, and what I'm going to say is, in many cases, might run contrary to some of the views which you've held for either a short term or a long term. But we're going to look at property as a way to generate regular, continuous income, both whether you invest directly with cash or you invest through your pension scheme. And with the changes that we've had in people's pension scheme, just as recently as the 5th of April, there are some dramatic issues which you may or may not yet know about. So we're going to take a look at that in terms of pension freedoms, and we're going to look at the issues around investing in cash or through your pension and the difference that the right investments can make and what they might be. So it's a big agenda, and I'm going to cover it in a very short space of time. For those of you who have questions, and I hope that will be many of you, I'd like to ask you to hold your questions to the end, because I want to cover a lot of ground, and I may well answer you anyway. What I would like to say is anybody who has questions that don't get answered at the end because we run out of time, I will go to the back and I will answer everybody's questions however long it takes. So just a little bit about me, because you might wonder why I'm standing here. Well, I made my first property investment, which happened to be a retail shop, in 1982. I've been involved with property now for 33 years, and I own a portfolio, residential and commercial, in the UK and abroad. I started life as a chartered accountant. I didn't practice as a chartered accountant. I left the day that I qualified. What it gave me was a very strong financial background and an aversion to risk. So when I talk about risk later on, my capacity, my willingness to risk is relatively low. And that's very important, because we're going to be talking about income that you can rely on as you move into retirement, or if you choose to retire early from the age that you are now. Along the way, as was mentioned, I've written a number of books. I wrote the first major course about property investment in the UK. I wrote a book called The Pensions Disaster and How to Plan for a Secure Retirement. And more recently, I wrote this special report called Property is Your Pension, which normally is £49, but I'm going to make available to all of you as a complimentary copy at the end of the presentation. My company, not surprisingly, focuses on helping people do better in retirement and in creating greater streams of income using a particular kind of property investment, and we'll come on to what it is and why we use that a bit later. Now, for some reason, this computer has decided to mess up some of my slides, but never mind. So clearly, we all want to do better all the time, and whether that's for income now or retirement later. And for some of us, problems have got in the way. And I don't want you guys to be looking like this. I'd rather you look like this. So we're going to take a look at what has happened that makes some people look glum, and how we do something about it. So some of you may have been watching the newspapers in the last couple of years. Here's just a tiny handful of headlines. Did anybody see the Daily Express yesterday? For us, it was a headline made in heaven: pension misery for millions, or something. The lowest annuity rates there have ever been. A quite complete disaster. So when I talk about pensions, I use it in two different contexts. I use it in terms of your retirement income, and I also use it in terms of a specific pension scheme that meets UK regulations. Here, it's being used in a rather general sense of retirement rather than specifically. Underlying this has been investment failure, and this is a bit of a strange show for me to be talking about this. But here's the thing. Some of you in this room, I'm sure, are traders, whether you trade in shares, commodities, forex, or whatever. You guys can make money if you get it right, whether the market's moving up, down, or sideways, and that's fantastic. But it is intensive, it requires your attention, and it's an alternative to having a job in a way. For those of you who are looking long-term and looking at long-term investment for the future, then you obviously need to take a longer-term view. And when you look at the FTSE 100 back to 1999, you'll know that we only recently broke new ground. And frankly, anybody who's been invested in a basket of shares across that period has not done well. Yes, it's true. The last few years have been exceptional. But what about the years before that? And what about the years to come? And all I can say is that when I look at a graph like that, and I think, would I trust that situation for the next 15 years of my life or the next 30 years of my life, it's very challenging. Now, I know that some people have a view that because the FTSE hasn't done well, it will do well, and they would be advised to go and look at what's happened in Japan. Most of you, because this is a very educated audience, will know that the Nike hit its last peak in 1990, and after 25 years is barely half the level that it was then. So time is no guarantee of return in the stock market. For those of you who have invested in fixed interest securities or have pensions, you're coming up to pension age with a traditional pension, and your pension provider will switch you into fixed interest. Who knows what the current rate of 10-year gilts is? Anybody know what the rate is? Sorry? 1.95, which before inflation, of course, which is pretty much nothing. Yeah. So the point is, if you have a traditional pension where the investments have primarily been made in equities, moving into fixed interest securities as you get close to retirement, but your pension will not be performing. You might have had a good year or two, but if you look at it over a 10 to 15-year period, it will have been a disaster. I look at pensions every single day for my clients, and on average, the return is somewhere between -2% and +2% after inflation. So, the second problem, and this is very specific to pensions, are fees and charges. Some of you may have seen a program that Panorama did called Who Took My Pension? Anybody see it? It was about 4 years ago now. But you can go and watch it on YouTube. And they asked a very simple question. They went to a dozen of the biggest pension providers and said, excuse me, please will you answer this question? Suppose somebody comes along, they invest £5,000 in their pension for the next 20 years, so their contribution is £100,000. How much of that £100,000 will you take in fees and charges across that period of time? So, what do you think would be reasonable? Anybody have a view? You pay the pension company 100 grand of your money, how much do you think they should take? They take 20. Okay, I asked how much do you think they should take, not how much do they take? 3.5%. Okay, so they asked this question. Here is one of the interesting answers, and this lady will say, hey, I've got it right. There's the 20% number, and I promise you that this lady's never met me in her life before. However, I'm afraid you're wrong. HSBC took 80%. And left 20%. Now, they were the worst. The average was about 45%. So pretty much half the money you contribute has been taken in fees and charges. Very challenging. What else is challenging? Life expectancy. If 50 years ago you were a guy of 65 and you died probably at 70, 5 years in retirement, now it's 20 years. Hugely problematical for the pension industry. Annuity rates. Here's how it's problematical. Here's the monthly annuity rate since 1990. So this is the rate of guaranteed income that you would get if you sold your fund. Back in 1990, it was about 17%. Now, on this table, it's just under 6, about 5.7. But that 5.7 is misleading because that 5.7 is based on no increase for inflation. Now, if you're going to live 20 years in retirement, you really need to make sure your income's going to go up. And if you go and buy an annuity today, this is after the Daily Express's headline of yesterday about this being a disaster, about the best you can get on a joint life, increasing with inflation, is 2.8%, which means that if you've got 100,000 in your pension, your income will be £233 a month. Who thinks that's enough? Anybody in the room? No. And then why do you have to worry about inflation? Well, if you live for 20 years and inflation runs at around 3%, it's actually running a bit less than that at the moment, your money roughly halves in value. That's why you have to take care of inflation. So given the challenges, if you're investing long-term in either funds/shares or fixed interest securities, the question is, what can you do about it? So we have a simple two-step process. One is fix the investments, get the right investments, and the second is choose the right investment vehicle, which for many people is a pension. Some of you may already have money in pensions which is deferred or frozen, not performing. It's already sitting there doing nothing. The very least you should do is do something with that. So let's talk about asset classes and where might you think about investing. Now, this is my personal view of the world. 4 major asset classes, and you, in your own mind, you can move these bubbles around wherever you want. This is just my view. But this is where I see fixed interest, low risk, low reward, equities in funds, medium risk, medium reward in theory, although that's not happened since 2000. Alternatives, much higher risk, questionable reward, but of course there's always the exceptions. You might pick a winner, you buy diamonds at the right time or the right vintage fine wine, you do incredibly well. So there's always exceptions. But here is my first love, which is property. Why have I put it here? Because if you have the right security and if you've bought at the right price, you absolutely fundamentally have to change the risk-reward pattern. And there's a lot of ifs, right? If you have the right structure, then the return you can get is very substantial. And at the beginning, I talked about 7 to 15% a year. Most of my clients who are investing currently are in the region of 10 to 12%. Who would be happy with 10 to 12% return net year after year after year as a consistent return? Would anybody be really happy with that? Or are you lying to me by keeping your hands down? Or you simply don't believe me? Okay. So last week I was at the Property Investor Show and I could have missed out a few of these slides because I was preaching to the converted. Some of you, I guess, have already got property investments. Who's got residential property investments, just so I get a feel? Okay, relatively small number. Many reasons. Diversification, compound growth, I believe is the 8th wonder of the world, non-correlated assets, high returns, lots and lots of reasons. Pension availability is really important if you are going to do something within a pension wrapper. Only certain kinds of property can go into a pension, and that's why we are very selective. High returns. When I say 7 to 15% net, just for clarity, I mean net, i.e. what you would get in your bank account before you pay tax. Now, if it's in a pension, there will be no tax. If you own it directly, of course, you'll pay tax. But most people, when they talk about property, particularly residential property, have a view that they talk about 8% return. That's before their property agent, before the service charge, before the ground rent, before the maintenance, before the voids, before the damages, before the non-payment, etc., etc. I'm talking about net. So what property investment? Well, within the property world, there are 2 sectors, residential and commercial. Residential, you're very familiar with. You buy a buy-to-let house or flat. I'm not talking about residential. There are 2 major reasons for that. One is you can't stick it in a pension. And the second is it doesn't fulfill particular criteria, which I'm going to show you in a minute. But commercial covers a vast raft of things. Does anybody know what the value of commercial property is in the UK in totality? In billions? It's about 900 billion. It's just short of $1 trillion. As a comparison, there's about 1.5 trillion in residential. So if you look at the whole market, it's pretty close to 2.5 billion, of which commercial occupies about 35–40%. So we are not talking about an inconsequential sector. The second thing you need to be aware of is there are two ways that you can own property. Most of you will only be familiar with the first, which is you own a freehold or a leasehold title, which gets registered at the land registry. Some of the investments we have follow that model. They offer an interesting mix of some income plus some capital growth. We also have a lot of investments that fit this model of indirect ownership, and this is really where you're acting as a bank alongside other investors. You provide a loan for a fixed time at a fixed return with security, and if that doesn't get paid, the lawyers will take the security. I have a lot of clients who like this because they can say, I only want to invest for 3 years and I want to know I'm out. I want to know what I'm getting, paid every year. So this creates certainty, this creates regularity, this creates future knowingness, but it doesn't have the potential for capital growth. But many of the investments in here will offer 10 or 12% annual return. And what I would say to you is that if I had the choice of an investment that offered 6% return and possibly 4 or 5 or 6% capital growth, or an investment that offered 10% return for sure with no capital growth, for much of the time I would take the income investment, particularly if you want income. If you want income, take income. So our focus is on commercial owned both directly and indirectly, and residential owned indirectly, because this actually takes it out of being actually technically a residential investment. Effectively, you're investing in a development proposition which makes it commercial. Now, this should say fresh strategy. Well, this slide's gone a bit bananas. But we have a 5-element strategy called FRESH, which stands for these things: fixed return, regular high income, exit strategy predefined, security in place, and hands off. That's what FRESH is. And within the residential market, most property investments do not meet half of those things. That's why there are the crosses there rather than the ticks. So what does our investment portfolio look like? Typically, it's 15 to 20 investments. And the reason for that is because the way we work with our clients is not typical of this industry. We have very much a consultative relationship where we can listen to you and we can hear what you want. How long? What kind of returns? Do you want income now or income and growth? Do you have preferences in terms of types of investment? And because of our broad range, we can then say, why don't you take a look at these 3? So it gives us the ability to match very closely what you're looking for. Now, I have to say that since last October, our friends at the Financial Conduct Authority have introduced some new restrictions, and some of these investments that we have are restricted to qualifying investors, typically those who are either high net worth or sophisticated, according to the government's definition. So let me give you some examples, and this first one I have to declare an interest in because I actually own this project. This is a project to build 132 starter homes, and it's in Romania, and many of you will either never have been there or not know much about it, or think that the whole of Romania is populated by gypsies who steal your wallet. Nothing could be further from the truth. But without going into the detail here, this offers investors either a 15% return for a 15-month investment or 36 months a compounded 40% return. And we are on phase 2, which is very important because the planning is in place, the infrastructure is done, we've bought the land, we're already building, and this is now moving into phase 2, which is far lower risk for investors than the ones that invested in phase 1. This is what has become our most popular investment. This is a company in Germany that restores historic buildings. They have a very interesting model of using investors' money to buy the buildings and bank money to refurbish them. And there's a tax break for wealthy Germans to actually buy the refurbished apartments, which are all in major city centres. And they offer a return of 10 to 12% net, either on a 2-year or a 5-year timescale. So this is self-storage. I'm just trying to show you a little bit of flavour for the different kinds of things. This investment, you actually own the title. So this is direct ownership, which is registered at the land registry, and you own 1 or more units inside a major warehouse. And the returns there are typically 8 to 12% a year over 6 years, plus the potential of capital growth. This is an investment in Dubai. These are car parking spaces underneath commercial buildings. Of all the things that we have, this, I can say, and I use this word advisedly, the income is guaranteed. And I say that because they have a third-party financial fund in Guernsey, which is legally contracted and has the funds in place to make up any shortfall should these people default. So it has a third-party independent guarantee. And there's the potential of capital growth here. This is ownership. So I've shown you 2 investments which are indirect and 2 investments which are direct. This is just a flavour. And the final one that I'll show you is this. This is a historic Scottish castle that's being turned into a 5-star resort. It's very famous. This is the castle that Queen Victoria stayed in her honeymoon. It's just north of Edinburgh. The River Tay, which is the best salmon fishing river in Scotland, runs through its grounds. It has an 18-hole golf course, and now the castle's being converted into a 5-star hotel and spa. It's an opportunity to own an extraordinary piece of history, and you can either have a guaranteed return that starts at 10% net, or you can use it yourself or your family if you wish. For me, if you want to leave something to your family when you die, this is something that you buy and tuck away. And the investment here starts at $27,000. So that was no more than just a little flavour about the investments, but let's now switch and look at potential investment vehicles. And I want to talk a little bit, and hope it will help you to talk about the pension freedoms and the changes that we've had. So the first thing is that annuities are pretty much dead. There is no requirement anymore to buy an annuity, and for most people, they are very bad value, and you should absolutely go nowhere near them. Okay? So long live what's called income drawdown, the ability to keep ownership of your fund. Be very, very nervous about buying an annuity. Rates are at an all-time worst low. For the first time now, you can own and control 100% of your fund, provided you're in a money purchase scheme, also called a DC, defined contribution scheme. You don't own your fund if you're in a final salary scheme. We'll come on to those in a minute. This is really, really important because it gives you lots of options. We'll come back to the options in a minute. You also now have the right to transfer a final salary scheme to a defined contribution. You might say, well, why on earth would I do that? I mean, aren't final salary schemes the best thing since sliced bread? Well, the first thing to say to you is that I've written a 20-page report about final salary schemes, and anybody who's got one is welcome to have a copy if you ask me afterwards. The reason that the government has done this is because most final salary schemes are bust, seriously bust. Does anybody know what the deficit is on private final salary schemes across the country? The deficit, by that I mean the shortfall of the amount that should be in the fund to pay the pensions that have already been promised. Anybody know what it is for Tesco's? It's been in the paper in the last few days, what their deficit is. Well, Tesco's deficit is £3.8 billion. That's a deficit which it's supposed to make up. But Tesco lost, what was it, £6.5 billion last year, so goodness knows how they're even going to survive, let alone make up the deficit in their pension fund. The global deficit across the UK there's two estimates. The government's estimate is 380 billion. Citibank's estimate is 850 billion. Now, given how difficult it seems to be for the government to find 10 or 20 billion in savings, what hope has it got of making up a deficit in people's final salary schemes of at least 300–400 billion? So there are reasons why people might transfer. So let's say you now have ownership of your fund. What can you do with it? And some of these things are new and they're really, really important. So if you want to, you can withdraw all of it right now, assuming you're 55. Utterly mad unless there is some overriding reason to do so, like you're about to be made bankrupt or something, because you have lost your entire pension fund. There could be reasons for some people who have lots of investment money outside their pension and perhaps a small pension fund to consider doing that, but you are taking money out of a non-taxed environment, putting it in a taxed environment. Generally, that's not a good idea, but you can do that. You can withdraw some now, 25% tax-free, and then you can use it in whatever way you want. You can keep it as a rainy day fund. I think that's fabulous, to know that you've got some money there should something come up unexpectedly which you need. You can use it to supplement your income over time. So, you know, you could, if your income, for example, from your pension fund is 12 grand and you want 14 or 16, or 1 year you want to do something special and take out another 10, you can treat it as a fund to do that with. Most importantly for me, if you've got family or other beneficiaries, you can leave it as a legacy. Now, this is utterly life-changing. This pension fund is free of inheritance tax. For those of you who've got significant inheritance tax bills potential within your estate, this is a way to begin to mitigate them. You can leave your pension fund to your beneficiaries. There will be no tax to pay unless and until they start to draw on it. If they draw it, they will pay tax at their marginal rate. So if they wait until they're retired and they're paying tax at 20%, they'll only pay tax on what they draw. So if they just draw income and never take the capital, there'll be no tax on the capital. They can leave it to their beneficiaries. They can leave it to their beneficiaries. For the first time, you can use a pension fund as a legacy for your beneficiaries for generations to come. To me, that is dramatic. But of course, you can't do that with a final salary scheme because you don't own the fund. And that's one huge reason. I have clients who've got £1 million in their final salary scheme, and their potential pension is like 20,000 or 25,000. If they invested that £1 million and moved into a DC scheme and got 8% a year, they'll have a pension of 80,000 plus ownership of the fund. That's kind of quite a strong reason to at least consider what to do. Now, this slide you might want to come back to, because I'll happily make these slides available to you. But this is a comparison of two people, one who invests directly with cash and one who invests through a pension scheme. Now, I understand that when you've got a pension scheme that's doing rubbish, you absolutely want to just get out of it. But I'm comparing now a pension scheme with a direct cash investment with the same return, and I've chosen to just take 10% because it's an easy number to illustrate. Clearly, you get 40% tax relief on the money to your pension scheme. You then don't pay tax on the income. The bottom line is that after 20 years, your fund is potentially going to be worth, after inheritance tax, around 200,000 if it's cash and 1.1 million if it's a pension. Now, we can argue about the subtleties of the numbers, but broadly, this is the scale of difference. If you look at the potential income that you can draw, it's about £1,600 from if you directly invested with cash, or £6,000 if it came out of a pension. For most people, that is like mind-blowing, but it's true. I'm an accountant, okay? So that's not, though, the only reason to invest in a pension. There are lots of reasons for investing in cash. You may have used up all your annual allowance, or you might be at the lifetime allowance. Maybe you're not 55 yet and you want income or capital. Some investments are only available to cash investors. You may want personal usage. For example, if you wanted to invest in the castle and you want personal usage, you can't do it in the pension. You might want to leverage your investments. So if you're buying residential property and you're borrowing at 75%, you can't do that in a pension. And you might want to be involved. And now typically those last two are younger people who've got the time, who've got the money, who've got the energy. They want to get maximum leverage, a small capital base, and they want to grow it as fast as possible. I'm mostly talking to investors who are older, who have done that and want to go the other way. They want to deleverage, take themselves out of involvement. Why invest in a pension? Well, the biggest reason is the tax relief. It's simply enormous, provided, of course, that you're properly invested. And now this legacy for beneficiaries. And, of course, if you've got money in a frozen or non-performing pension, deferred pension, I mean, don't just leave it sitting there doing nothing. Do something with it because, you know, it's already there. So the bottom line is that the investment performance is critical. Then the pension wrapper, if you choose to have one, adds value, flexibility, and lots of tax benefits. Okay? So the question is, if we bring all this together, is there a better outcome? And let me just show you some examples. Let's say initially you're going to invest for income. So here we have Mr. and Mrs. Glum, and they had 100,000 of capital which they put in a building society. I know none of you would be daft enough to do this. They got 2% annual interest, which is pretty generous, and they earn 166 a month. Here we have Mr. and Mrs. Happy. They took the same money. They invested it in a 3-year loan note, which paid them 12%, which you could have right today, and they got £1,000 a month income. Same money, very different outcome. So what about people who are saving for long-term for retirement and don't need the income now? So let's say, so they're going to do it in their pension. Mr. and Mrs. Glum do something very traditional. They have a normal pension fund, 100,000 of capital, 20 years growth. It grows at 2%, which is at the top end of what I see. Their fund value will be 148,000, okay, after 20 years. You can check all these numbers out. Mr. and Mrs. Happy have achieved 8% growth, which is on the bottom end of what my clients are achieving. Their fund is worth 466,000. Same investment period, same money. This is all about changing the momentum of growth. But this isn't the end of it, because these guys went and bought an annuity, and I've been generous and said that they got 3%. They wouldn't get that at the moment. Their income is £370 a month. These guys kept their investments, decided not to take the whole 8% that they're making, so they've left 2% behind to grow the fund. They're taking 6%, and their income is £2,300 a month. Same period, different investment strategy, different retirement strategy. What do you guys want? 300 a month or 2,300 a month? But that's not the end of it, because they've all got family and they'd like to leave something. Unfortunately, Mr. and Mrs. Glum bought an annuity, no fund. These guys kept ownership. So now their fund is worth nearly £500,000, plus it's growing with inflation. So it's really quite simple. With all of that, what do you do? Well, hopefully on your chair or next to you is a form like this. So if you'd like a free copy, hopefully you can grab one of these now. If you'd like a free copy of my report, Property as Your Pension, which has got all of this and a lot more in, and also you'd like a copy of this presentation, which we'll include, if you'd like to tick the first box that says Property as Your Pension, then we will happily send you one. It comes in the post, so I do need your full address, and please write in a way which I can read, because otherwise we won't be able to send it to you. So I'd like to offer you that. Second thing is, if you have a pension, or pensions, as some people do, which is not performing or frozen, and you would like an independent review, which will really give you an insight into what's happened to it, where it is now, what's likely to happen on retirement, and what other options there are, basically to give you back control of your future, then you can tick the box that says complimentary pension review. And my office will give you a call next week to put that in hand. The third thing is, if some of you have got cash or other investments which are not achieving 8, 10, 12% a year return, and you want income today in that order with a minimum of £10,000 to invest, then tick the box, please, that says discuss cash investments. And when we finish, which will be in a few minutes, Jade, where's Jade? Jade will be standing at the back if you'd like to hand your forms in. If anybody hasn't got one, just look left and right, and there should be plenty on the seats. So I've got time now to take a few questions. I hope you've enjoyed that. I've packed a lot into a short space of time. Who's got some questions for me?